general increase in the cost of products and services over time, which reduces both consumer and company purchasing power, is referred to as inflation. To put it another way, your dollar, or whatever currency you use to make purchases, will not go as far as it did yesterday. Take a regularly used product and compare its pricing through time to gain an understanding of how inflation works. For instance, the average cup of coffee cost 25 cents in 1970. By 2019, that price has increased to $1.59. In contrast to 20 cups of coffee in 1970, you could get approximately 3 cups of coffee today for $5. That's inflation, which refers to price increases across an industry, like retail or the automobile industry, and eventually, a whole nation's economy. It's not just restricted to price increases for any particular good or service. Economic experts view yearly inflation in a healthy economy as being 2 percentage points or less, which is an indication of pricing stability. When inflation is within acceptable limits, it can also have a good impact. For example, when the economy is sluggish and needs a boost, it might stimulate spending, which will increase demand and productivity. On the other hand, it might be a symptom of a troubled economy when inflation starts to outpace wage growth. The direct victims of inflation are the general public and companies. Here is a basic breakdown of how inflation impacts businesses and consumers differently. When the costs of the things households buy, including food, utilities, and gasoline, go up, their purchasing power decreases. When the cost of production inputs such as raw materials like coal and crude oil, intermediate goods like grain and steel, and finished machinery rises, businesses lose purchasing power and run the danger of seeing their profit margins shrink. In order to counteract inflation, businesses often increase the cost of their goods or services, with the result that consumers must pay the price rises. The challenge for many businesses is to balance the need to raise prices to cover rising input costs with the need to avoid doing so to the point that it depresses demand, which is covered in more detail later in this article. How is inflation determined? The current value of a basket of different products and services purchased by households, referred to as a price index, is how statistical organizations first calculate inflation. In order to determine the rate of inflation, or percentage change over time, agencies compare the value of the index over one period to another, such as month to month, which results in a monthly rate of inflation, or year to year, which results in an annual rate of inflation. For instance, the United States Bureau of Labor Statistics disseminates its Consumer Price Index, CPI, which calculates the price of goods that urban consumers pay cash for. The CPI is segmented by geographic area and reported for the entire nation. The U.S. government's Bureau of Economic Analysis publishes the Personal Consumption Expenditures (PCE) Price Index, which includes healthcare costs among a wider variety of consumer spending. Additionally, data gleaned from commercial surveys is weighted. What are the principal reasons for inflation? There are 2 main forms of inflation or causes of inflation. Demand pull inflation happens when the economy's need for goods and services outpaces its capacity to supply them. For instance, when demand for new automobiles rose more faster than expected after a dramatic decline at the start of the COVID-19 epidemic, the automotive sector struggled to meet the increased demand due to an interim deficit in semiconductor supply. Price increases for both new and used cars followed the ensuing lack of brand new automobiles. Cost-push inflation happens when the price of input products and services rises, driving up the cost of output goods and services. For instance, during the pandemic, commodities prices rose dramatically as a result of fundamental changes in demand, purchasing habits, cost of serving, and perceived value across industries and value chains. Industrial firms were compelled to think about price increases that would be passed on to their end customers in order to offset inflation and limit the impact on financial performance. Discover more about McKinsey's pricing methodology. How is current inflation different from past inflation? Due to rising energy prices, labor shortages, and supply interruptions, inflation in the United States increased to 7.5% in January 2022, which was its highest level since February 1982. However, governments have dealt with inflation throughout history. It is not a recent occurrence. The post-World War II era is sometimes used to contrast the current inflationary period, when price controls, supply issues, and unusual demand-generated double-digit inflation rises that peaked at 20% in 1947 before declining at the conclusion of the decade, according to the U.S. Bureau of Labor Statistics. Similar distortions in consumption patterns have occurred today, and the pandemic has hampered supply lines. The Great Inflation was a period of high inflation, with rates peaking at 14.8% in 1980 and lasting from the middle of the 1960s to the beginning of the 1980s. The Federal Reserve boosted interest rates to over 20% to stop this inflation. Some economists blame this event partly on poor monetary policy rather than other alleged causes like high oil prices. The Great Inflation made it clear that the public needed to have faith in the Federal Reserve's ability to reduce inflationary pressures. How does price change due to inflation? Inflation often results in higher input costs for businesses. Consumer price hikes are one way for businesses to make up for losses and maintain gross margins, but if done carelessly, price rises can harm customer relations, reduce sales, and hurt profitability. Businesses can make better choices if they have access to an exposure matrix that evaluates which categories are subject to market dynamics and if the market is expanding or contracting. Recovering the cost of inflation for a certain product when done correctly can improve partnerships and overall profitability. To adapt, adjust, develop, accelerate, plan, and track to inflation, businesses can follow these 5 steps. Discounts and promotions should be adjusted, and other parts of sales that are unrelated to the base price should be reviewed, such as extended production timelines, surcharges, and delivery costs for urgent or low-volume orders. Create a price change science and art. Instead of making general price changes, adjust your pricing strategy to take inflation exposure, consumer willingness to pay, and product qualities into account. Decisiveness should be 5 times faster. Create an inflation council of committed decision makers from several departments who are focused on inflation and who can react swiftly to client feedback. To cut costs, consider methods other than pricing. To restructure your portfolio and offer cost-saving alternatives to price hikes, use value engineering. Continually monitor performance. Create a central support team to deal with revenue leakage and to strictly manage performance. Beyond pricing, a number of commercial and technical tools can aid businesses in coping with price increases in an inflationary environment, while other industries could need a more specialized approach to pricing. For instance, category managers in the chemical sector can take the following 5 actions to reduce costs for their businesses as a result of rising commodity prices. Completely comprehend the dynamics and outlook of the supply market. Rectify price increases when the underlying factors that cause them are no longer present by understanding and monitoring those factors. 1. Make sure that suppliers can articulate precisely how price changes in the market affect their own prices. Sellers frequently overestimate the proportion of raw materials in input costs during periods of upward price pressure, taking advantage of the chance to boost their margins. To recognize and confront these circumstances, it is crucial to use the clean sheet process. 2. Consider necessary price hikes as one-time extra costs rather than a sign of the future. Because it places the burden of proof on the seller, this partially psychological process is particularly successful at addressing the stickiness of price rises. 3. Place cross-functional projects first. Improvements in yield, waste reduction, or substitutes may have a greater impact when costs are high. Now is the moment to give them top priority if any are accessible. 4. Pass on price hikes by working with sales. Category managers collaborate closely with the finance and commercial teams to clarify pure market effects and their bearing on product prices while ensuring that the proper justifications are put forth to pass market price hikes to customers. 5. How do deflation and inflation differ from one another? Deflation is the other end of the pricing range from inflation, which lies at one end. When an economy's general level of prices falls and its currency's purchasing power rises, this is known as deflation. It can be caused by an increase in production, an abundance of products and services, a loss in aggregate demand, or a reduction in the availability of credit and money. In general, moderate deflation is good for consumers' wallets because it allows them to spend less money on more items. Deflation, on the other hand, might indicate a deteriorating economy and trigger recessions and depressions. Inflation lowers purchasing power but raises the value of debt at the same time. Conversely, debt increases in cost during a period of deflation. During times of inflation, consumers can also defend themselves to a certain extent. For instance, consumers whose funds have been invested may experience earnings growth that is greater than the rate of inflation. However, during periods of deflation, investments like stocks, corporate bonds, and real estate become riskier. Subscribe for more information like this. For more similar videos, join this channel.